Welcome to Muscular Brain Fat Wallet. In today's video, we're diving deep into the world of exchange-traded funds, or ETFs. If you're looking to enhance your investment strategy and build a strong financial future, understanding ETFs is essential. This video will provide you with everything you need to know about ETFs, including their benefits, types, and how to choose the right ones for your portfolio. Section 1. What are ETFs? Exchange-traded funds, ETFs, are investment funds that are traded on stock exchanges, much like individual stocks. They are designed to track the performance of a specific index, commodity, or asset class. ETFs can include a wide range of securities, including stocks, bonds, and other assets. Key characteristics of ETFs. Diversification. ETFs typically hold a basket of securities, allowing investors to diversify their portfolios without having to buy individual stocks or bonds. Long liquidity. ETFs can be bought and sold throughout the trading day, providing investors with flexibility and real-time pricing. Lower costs. Many ETFs have lower expense ratios compared to mutual funds, making them a cost-effective investment option. Section 2. The history of ETFs. Understanding the evolution of ETFs can give you a better perspective on their significance in the investment world. Origins. The first ETF, the SPDR S&P 500 ETF Trust, SPY, was introduced in 1993 and aimed to provide investors with exposure to the S&P 500 index. Growth of ETFs. Since then, the ETF market has exploded, with thousands of ETFs available today that cover various sectors, geographies, and asset classes. Section 3. Benefits of investing in ETFs. Investing in ETFs offers several advantages that can enhance your investment strategy. Diversification. By investing in an ETF, you can gain exposure to a wide array of stocks or bonds, reducing the risk associated with individual securities. Cost-effective. With lower expense ratios, ETFs can help you keep more of your investment returns compared to traditional mutual funds. Tax efficiency. ETFs typically generate fewer capital gains distributions, which can result in a lower tax burden for investors. Accessibility. ETFs provide an easy way to invest in various markets, including international markets, emerging economies, or specific sectors. Section 4. Types of ETFs. ETFs come in various forms, each designed to meet specific investment needs. Here are some of the most common types. Equity ETFs. These ETFs invest in stocks and aim to replicate the performance of a specific index, such as the S&P 500 or the NASDAQ. Bond ETFs. These funds invest in fixed income securities and provide investors with exposure to government bonds, corporate bonds, or municipal bonds. Commodity ETFs. These ETFs invest in physical commodities such as gold, silver, or oil, allowing investors to gain exposure to commodity prices. Sector and industry ETFs. These funds focus on specific sectors or industries, such as technology, healthcare, or energy. International ETFs. These ETFs provide exposure to foreign markets, including developed and emerging markets, offering investors geographic diversification. Thematic ETFs. These funds target specific investment themes, such as renewable energy, artificial intelligence, or cybersecurity. Section 5. How ETFs work. Understanding how ETFs function is essential for effective investing. Creation and redemption. ETFs are created through a process called in-kind creation, where authorized participants, APs, exchange a basket of underlying securities for ETF shares. Conversely, shares can be redeemed for the underlying securities. Market pricing. Unlike mutual funds, which are priced at the end of the trading day, ETFs trade throughout the day, with prices fluctuating based on supply and demand. Tracking error. This refers to the difference between the ETF's performance and that of its underlying index. A low tracking error indicates that the ETF closely follows the index. Section 6. How to invest in ETFs. Investing in ETFs is relatively straightforward, but it's essential to have a strategy. Determine your investment goals. Assess your financial goals, risk tolerance, and time horizon to identify which ETFs align with your investment strategy. Research ETFs. Look for ETFs that match your investment criteria. focusing on factors such as expense ratios, historical performance, and holdings. Choose a brokerage. Select a brokerage that offers access to a wide range of ETFs, low trading fees, and a user-friendly platform. Place your order. When you're ready to invest, place your order for the ETF just as you would for a stock. You can choose between market orders or limit orders. Monitor your investments. Regularly review your ETF holdings and rebalance your portfolio as needed to align with your investment goals. Section 7. Risks of investing in ETFs. While ETFs offer several benefits, they are not without risks. Here are some common risks to consider. Market risk. Like any investment in the stock market, ETFs are subject to market fluctuations and can lose value. Liquidity risk. Some ETFs may have low trading volumes, which can make it difficult to buy or sell shares at your desired price. Tracking error. As mentioned earlier, ETFs may not perfectly track their underlying index, leading to discrepancies in performance. Sector-specific risks. Investing in sector or thematic ETFs exposes you to risks specific to that sector, which can be more volatile than the broader market. Section 8. Tax implications of investing in ETFs. Understanding the tax implications of ETF investments can help you manage your tax burden. Capital gains distributions. ETFs generally distribute fewer capital gains compared to mutual funds, making them more tax efficient. Qualified dividends. Dividends paid by ETFs may be considered qualified dividends, which are taxed at a lower rate than ordinary income. Tax loss harvesting. Investors can sell losing ETF positions to offset capital gains in other investments, potentially reducing their overall tax liability. Section 9. Comparing ETFs to mutual funds. ETFs and mutual funds are both popular investment vehicles, but they have key differences. Trading. ETFs trade like stocks throughout the day, while mutual funds are priced at the end of the trading day. Costs. ETFs generally have lower expense ratios than mutual funds, making them a cost-effective choice. Minimum investments. Many mutual funds require minimum investments, whereas ETFs can be purchased with no minimum investment. Tax efficiency. ETFs tend to be more tax efficient than mutual funds due to their unique structure. Section 10. Strategies for investing in ETFs. Here are some effective strategies for investing in ETFs. Dollar cost averaging. This strategy involves investing a fixed amount regularly, reducing the impact of market volatility over time. Diversification. Spread your investments across various ETFs that target different sectors, asset classes, or geographic regions to minimize risk. Core satellite strategy. Use a core holding of broad market ETFs to provide stability, complemented by satellite investments in sector-specific or thematic ETFs for growth. Rebalancing. Periodically review and rebalance your portfolio to maintain your desired asset allocation and risk level. Section 11. Future trends in the ETF market. The ETF market continues to evolve, with several trends shaping its future. Growth of thematic ETFs. As investors seek exposure to specific trends, thematic ETFs targeting areas like ESG, environmental, social, and governance, investing, and technology are gaining popularity. Active ETFs. A new wave of actively managed ETFs is emerging, allowing managers to make strategic investment decisions while maintaining the benefits of ETF structures. International expansion. ETFs are increasingly being launched in international markets, providing investors with more global investment opportunities. Technology integration. The rise of robo-advisors and fintech platforms is making it easier for investors to access and invest in ETFs. Conclusion. In conclusion, exchange-traded funds, ETFs, offer a versatile and cost-effective way to invest in the markets. By understanding their structure, benefits, and potential risks, you can effectively incorporate ETFs into your investment strategy to build long-term wealth. Thank you for watching this comprehensive guide on ETFs. If you found this video helpful, don't forget to like, comment, and share. Subscribe to Muscular Brain Fat Wallet for more insightful content on financial intelligence, investing strategies, and personal growth.